Hi, folks. How's everybody doing? Okay, we can't really see you guys, but hopefully we can hear you. So it's a tremendous honor to be here. Thank you to Monetary Authority of Singapore, to Elevandi for inviting all of us here. And what better way as a segue from a discussion around Jeremy Lair talking about stablecoins to have a former regulator, policymaker, two current regulators, all the way from the United States, from India, to talk about how do we kind of regulate all this stuff? How do we protect the industry from the ill effects of all of this crypto, decentralized finance, distributed assets, digital assets, but also how do we create an environment to promote and encourage innovation? So let me just ask Adrienne to start us off, because Adrienne, you've had a tremendous background, not just in policy and regulation, but you've been an attorney, you spent time in the private sector with fintech companies. Tell us a little bit at a personal level, how was your experience in the past in the private sector? How does it make you a better regulator? And put it in the context of the challenges that are facing us currently, not just in financial regulation, particularly in crypto regulation.
Yeah, absolutely. Well, thank you so much, and thanks to MAS for having me. I think for me it's been really instructive to have been an attorney on Wall Street, to have been in the Treasury Department in the Obama White House, to have started my own fintech company that then went public, to understand what the private sector needs in terms of clarity with regulation, to understand how to write rules and make policy that can be operationalized by companies, that are clear, transparent, how to engage industry, and then how to anticipate what either the pushback will be or what's going to be helpful, what's going to be harmful. So I think having that well-rounded and diverse background really does make me a better regulator. And especially, we're really the only regulator in the US at DFS with explicit crypto authority. We're a prudential regulator of crypto. And having been in the entrepreneur's shoes and understanding the pressures to move fast, to grow your business, but also having been on the policy side and having to understand the many equities that you deal with as a policymaker, I think having both of those views hopefully makes me a more effective regulator.
Tremendous. I'm going to ask Sheila next. Sheila, you spent a long time in policy and regulation, and can I just say at a personal level, as I said to you over breakfast, what an honor it is to have you up on stage, because I remember back in 2008, watching what was happening in the financial crisis and feeling confident that we had folks like you at the helm. Give us a sense over your career of managing policy and regulation. What have you learned over that period of time that through that lens makes you look better at what the challenges today are broadly around financial regulation, stability, which is an area that you've spent a large part of your career on.
Right.
And if you can somehow bring that back into the challenges facing us in the overall digital asset crypto space.
Right. Well, it certainly made me acutely aware of the frailties in the system we had then, and to some extent the system we continue to have. There have been some meaningful reforms. Banks have more capital, a little less risk-taking, better consumer protections. But it is still a highly intermediated system, very concentrated system, dominated by very, very large financial institutions that generally have a lot of high levels of leverage. So there's some pretty obvious weaknesses, and distributed ledger technology, shared ledgers, could ultimately be the solution to the extent we can decentralize a lot of this risk. If we can do it responsibly with good governance, good operational integrity. I mean, there are going to be issues with that potential transition as well. But I do think we need to be open, regulators and policymakers need to be open to the prospect of decentralizing a lot of this, especially in the payments and clearing and settlement space. Could really make a better system. So we do want to make sure it's better before we launch too far ahead. But I do just the awareness of the problems we have now make me still look for solutions. And I think distributed ledgers is part of the solution.
Sounds great. Rabi, you've spent 32 years at the Reserve Bank of India.
Yeah, close.
And you've seen what tremendous change India has gone over that period of time.
Yes.
Tell us, looking at that time as a central bank policymaker, regulator, overseer, tell us what have you learned over that time, and through that lens, how do you look at the challenges that are facing financial regulation in India, and particularly if you can, since the panel is around crypto or blockchain and digital assets, talk about some of the challenges you're looking at over that period of time at this point, in India? And we'll talk about what's happening. I want to have, really, we're in Singapore here. We've got American representation, we've got Indian representation. We'll have a couple of questions and hopefully a 5-minute robust dialogue around how are jurisdictions all over the world thinking differently or similarly around all of this stuff. And India has had a very unique point of view on that. We'll talk about that in contrast in some cases to what the American point of view is. But back to your question at a more personal level, 30 years at the central bank, tremendous tenure. What have you learned? How do you bring that to bear to the challenges that are facing India today?
Yeah, in the context of crypto and DeFi, I think of the 32 years, we can pretty much give up the 27, the first 27, and just focus on what's happening, in the last 3 to 4 years, 5 years in the crypto space. One thing that is fairly clear is that the way traditionally regulation of financial sector happens, won't really work here. One has to, look at and think at things differently. For two primary reasons. One reason is that traditional regulation or supervision is focused on intermediaries, largely, and the responsibility that intermediaries have in delivering financial products. Now, the essential features of crypto technology or DeFi is the absence of intermediaries in a sense. Therefore, that doesn't work. The products that we are used to in traditional finance, how products are purchased or sold or bought or lent or held or transferred, all is premised upon a certain understanding of products, and that doesn't work very well in the crypto space. Products cannot be very clearly defined. For example, a cryptocurrency, how exactly is it a currency in the absence of anyone who has issued it, or in the absence of it being any person's liability? How is it a financial asset? They don't answer to the traditional question. So we'll have to think differently. The DeFi space is evolving, so we'll have to actually wait and see. It's exciting. One is looking forward to it. In the absence of intermediation, in the absence of intermediaries, there is a possibility that the cost of transactions could come down. There is a possibility that integrity of transactions with smart contracts and all can be improved. So we will basically have to, coming back to my personal experience, unlearn what we have learned in the past few decades and see how this technology evolves. We are excited about the blockchain technology. We are using it ourselves in the central bank, so in the CBDC space. So we will have to look at how things evolve in the private sector, how things settle down, and then probably take it as it comes.
I think it's really refreshing to hear from a central bank leader to talk about the fact that you sort of look at your broad experience and just recognize that we're looking at something different, right? And how do we sort of get ahead around that? So I kind of respect that to quite an extent. Adrienne, question to you in New York. I mean, I'm in Massachusetts, so in the absence of clear rules and responsibilities, classification of some of the products in this space at a central level, I can say that being in the private sector, so I can take the liberty of saying things since I'm not a policymaker. That lack of confusion between, is it a Federal Reserve, is it a Fed thing, is it a CFTC thing, SEC thing? In the absence of clear delineation, New York has had the responsibility, and you've actually used it as an opportunity to actually lay the law in New York State, and which makes you as a leader, as a state that other states watch and other jurisdictions watch. That obviously comes with challenge, as they say that if you want to conduct the orchestra, you got to be comfortable turning your back against the crowd. So talk about some of the challenging issues you've had to deal with in New York State without central government having laid the rules.
Yeah, it is a challenge, but as you said, it's also an opportunity, and it's one of the beauties of the system that we have in the US, however confusing and convoluted it sometimes is. For us, I often say, if you were starting from a blank slate and you were going to step back and say, what does good look like in crypto regulation, I think you would come up with essentially what we have in New York, with capitalization requirements, cybersecurity requirements, BSA, AML requirements, On the stablecoin side, one-to-one reserving, redemption requirements around the asset mix. And we've been working very hard with federal regulators to help them learn from our experience. New York has been regulating the space really since 2015. So we've been saying to federal regulators in the US, to regulators around the world, learn from our experience. We can tell you what's worked well, what needs improvement, but there is a framework here, there is a model here that we should all be building off of. And it's incredibly gratifying for me when I talk to other regulators around the world and they say, well, we know if a company has passed New York's test, it'll be good for our purposes as well. And I think that's an important signal that we can send out of one of the world's financial centers, that we really are keeping up with changes in the space. But I completely agree with the Deputy Governor. There are ways in which some of the traditional frameworks work well, but I think there are far more ways in which you can't shoehorn the regulation of crypto and DeFi into just securities, just commodities, just currency. You have to unlearn and think very differently, and especially, we talk about issues of, well, is it software? Is it a financial instrument? And our old rules would say, well, you can't regulate software. That's sort of outside your remit. But I think it prompts us to ask the question, right? How do we think about this? Because it's software, but it's also functioning like a financial instrument. So I think it really is causing regulators to re-examine a lot of our learned understandings.
I'll get into the stablecoin issue a little bit because I think it's very, very relevant. But the way you one framework of looking at this space is, one, you've got instruments of which we have cryptocurrencies, how many ever they are, but Bitcoin, Ethereum, all the like. So one of the instruments. And then you've got all these what are broadly called digital assets, which could be any kind of tokenized instrument, which, by the way, it could be a security, it could be a financial instrument, it could be art, as we've seen in NFTs. It could be tokenizing a reputation over time, right? So it's endless possibilities. So one is talking about the instruments themselves. Second is the idea of decentralized finance, that if there are entities that are basically unregulated software companies that are taking the role, that are using smart software to replace the role of trust that was provided by regulated entities, that's another element. And we'll get to talking about the third issue, which I know, Sheila, you're very big on, and you sit on the board of a number of companies in that space, is what do we do with the underlying technology? And Rabi, you were talking about that as well, the blockchain technology. Forget about the instruments. Let's just use blockchain technology, like we saw yesterday with JP Morgan doing a cash tokenized transaction, thanks to Monetary Authority of Singapore as part of Project Orchid, very successful venture, which has nothing to do with the cryptocurrencies. So let me just take each one of those issues very quickly. Let's just start talking about the first thing, which is instruments, right? A lot of confusion around the world around jurisdictions, how they're dealing with Bitcoin, crypto. India for a while talked about trying to ban Indian citizens holding cryptocurrency. Right now, that's not the policy, but you've taxed, quite seriously crypto transactions. So that's very different than the United States, which has got a little bit more laissez-faire approach to that right now. Just wait and see. But if I can ask you, Rabi, to take the lead on that, look beyond cryptocurrency, and if this idea of tokenization of assets, both current assets and future assets, how do you look upon that over the next 15, 20 years? How are we going to regulate all those instruments that go beyond cryptocurrencies?
Let's say in one phrase, a move towards more efficiency. That's how I would look at it, because you digitize it, you tokenize it, whether it's an asset or whether it's a piece of art or whether it's money, it can move far more efficiently than otherwise. So in general, yes, it's a move towards more efficiency. Like I said, there's a lot of excitement about blockchain, digital distributed ledger in general, although it's taking a while. It's probably more than a decade now since it's been there. It's taking a while. There are issues regarding its scalability. That's something that we have faced. We have to see whether this technology is good enough for instant transactions on a population scale. So far, it don't look very, exciting. Having said that, but I'm sure technology will evolve and probably take care of these shortcomings over time. But having said that, the technology itself holds a lot of possibilities. I think where we as regulators or, the general users need to take into account is not to get too excited about something because it's new. The first thing we'll have to establish is which of these many products serves a purpose that traditional finance cannot. Focus on that. That could be one way technology could take a direction. There's not much benefit in doing something that traditional digital finance can do just as well. For instance, I'm just giving you as an instant. I can't really think of, once, given the fact that you accept the technology, I can't really think of any additional use case of a stable coin linked to a dollar that a digital dollar cannot do in itself. So we have to do a lot of hard thinking instead of getting too excited about the technology itself. We have to do some thinking about the products and then come out to that. I'm focusing myself on finance. I'm sure they have a lot of use in art or in other areas. I'm just focusing myself on finance, and there I think we have to be particular. We have to be a little bit careful. As regulators, yes, throw water on the fire. That's, let's just step back a little, look at things, and then take a call.
Adrienne, tell us from your lens, as you look forward beyond this idea of tokenization of assets, what's the longer term framework, if I can request you to think next 10 years? How do we sort of, beyond cryptocurrencies, tokenized equities, fixed income, real estate, mortgages, intangible assets, just talking about instruments, we'll talk about the technology in a second. How do we think about that?
Well, I think this is the challenge as a policymaker, and I was talking with a group yesterday, right, and it is one of the things that makes public service particularly challenging versus the private sector, is thinking about how you protect a number of equities, not in the financial instrument sense, but in terms of the sheer number of stakeholders that you have and things that you need to be thinking about, from consumer protection to market stability, institutional stability, national security, and all of these things. But I think it will be incumbent upon policymakers, regulators, to be engaged with a whole set of stakeholders, including industry, to be thinking responsibly about the existing frameworks we have, what needs to be tweaked and evolved, and how can we come up with frameworks that protect consumers, institutions, and markets, but also allow for responsible innovation in the space. And there are no easy answers, and there are no quick fixes, but I think that's why the dialogue becomes so important, and I think in particular looking for innovations that really do solve problems, right? Not just innovation for innovation's sake. And that's going to be, I think, an important part of the dialogue, and how we all come to think about how to properly regulate things that we don't even know will exist yet. But I will tell you, I think you'll be hard-pressed to find any regulator, or at least any financial regulator, that is looking for things that really don't fall into their purview. We get asked a lot about NFTs and music and art and tickets, and is DFS going to regulate these things? I'm like, I have no interest in regulating these things, but to the extent these assets are shape-shifting and become financial in their use case, then we need to be thinking about how do we protect consumers and institutions and markets and help the space develop responsibly.
That makes sense. Let's just spend a few minutes talking about stablecoins, because I think, Rabi, you talked about that. Sheila, you've got some experience with companies that are, you sit on the board of companies that are in that space. We had Jeremy Lair talk about that. Let me just frame the issue in very quick way that, stablecoins, the common understanding is that they will be the central bridge between traditional finance and all these tokenized world, right? I think we kind of accept that and agree with that. Now, the approach to that is we've got sovereign CBDCs, right? As the Indian finance minister has announced, the next 12 months, you'll have the digital rupee. It'll be a blockchain-based, essential, CBDC, basically.
We just started a pilot on the first. Yeah.
Can you spend some time talking about that? Over the next 12 to 24 months, what can we expect about the Indian digital rupee? And how is it going to be different than just an automated, the way we had a rupee deposit and electronic deposit account? How is that different than the stablecoin you're going to be issuing?
we too are looking to learn. The vision we have is that we want to introduce a digital currency which is as much as possible the exact replica of the physical currency. So if a physical currency transaction is anonymous, we try and make digital transactions anonymous. Now, I know that's a challenge technologically, I know that's a challenge legally, but we are looking at it. It needs to have all finality, anonymity, all the features of a currency. We are not looking at making this a separate kind of a central bank liability. For example, some countries have need for CBDCs paying interest. That serves certain specific purposes. But then the way we look at it is that's not currency, that's not cash. So we are looking at a CBDC which is exactly like cash, no interest, no remuneration. Now we know that, and given the fact that it does not have interest, we don't look at that as challenging bank deposits as such. But we still do not know how behavior will change once we start introducing it, once people start using it. It depends on how well it is possible technologically to ensure anonymity and so on. But then we do not want to introduce it wholesale and then deal with the consequences. I think the responsibilities are too many. We cannot let the banking system come under stress because of this. So we want the process to be, gradual. So we are taking it as it comes. We'll start off with small pilots and then expand the scope. So that's as far as the way we are looking at CBDC. In terms of stable coins, I think we have to make a distinction between the use of stable coins in countries that are fully convertible on the capital account and the countries that are not, because that's very significant. They serve the same purpose, and for a country like India, which has capital management tools in employment, vis-a-vis, let's say, US, which is far more open. Now, in the case of a country like India, we'll have to give stable coins the same treatment that we give to any non-fiat currency. For example, if dollar cannot be used for transactions in India, we cannot allow, unless the policy changes, we cannot allow stable coin linked to dollar being permitted for transactions in India, because that has capital account consequences. Whereas that's not the same, let's say, for the US. For the US, this is just encouraging different private currencies, instruments, businesses, and so on. We have to look at our capital account policy. So there is a dichotomy in the way you deal with stable coins depending on your capital regime, depending on the level of your economic development. I think that is a point that regulators world over, when they set up standards globally, need to think about.
No, that's critically important, and recognizing the fact that different countries have a different set of circumstances, and the instruments that make sense for that country depend upon the circumstances. Sheila, if you could talk about the fact that you've got these central CBDCs,
right,
and then you've got these private stablecoins, right?
Right.
We heard from Jeremy, Paxos, there's so many other stablecoins, private stablecoins. Right. What's the economic rationale for private stablecoins to exist if what Rabi is talking about, central bank issued, CBDCs and stablecoins actually sort of, come online?
Right. Well, I think there are going to be different objectives. I think for the commercial uses for privately issued stablecoins, appropriately regulated, and hats off to DFS for really leading the way and making sure the stablecoins are truly stable, at least the ones that you oversee. I've been a big fan of CBDC, retail and wholesale, but if for retail, I assume the central banks aren't going to disintermediate the system, right? So there's going to have to be some caps on how much you distribute, how much per household you'll get. I think for the transmission of monetary policy, helping an economy in a downturn as well as getting assistance more directly, more efficiently, I think a retail CBDC has a lot of promise. You can program it, right, so it can have a particular purpose. For the privately issued coins, I see that more in the payment space. It has not gotten, beyond crypto markets, it hasn't gotten wholesale adoption, widespread adoption at this point, but I think it will. And I think it can easily coexist. I think they'll be compatible. I think you could probably use CBDC as one of the reserve that back a privately issued stable coin. So I don't see, I think this actually helps the ecosystem. I don't think it hurts it at all. And I'm glad to hear that many central banks are looking at both retail and wholesale CBDC.
That's great. Adrienne, quick, if you can spend a minute on that, because New York has again taken leadership role in defining what the reserve requirements need to be for private stablecoins. Just get us up to speed quickly on that. What's going on?
Yeah, so we in New York had not approved any algorithmically backed stablecoins, so the only coins we've approved are indeed stable. We require one-to-one reserving on-chain, off-chain, and we're pretty prescriptive about the types of assets, basically cash and cash equivalents that can be reserves, and we require a T+2 redemption timeline for our approved entities. And I think it's a good model. I think it proves that you can keep the institutions safe, you can protect consumers using that model. And I agree with the chair. I think there's room for the private and the public, as they'll have different use cases, but there's a ton of promise, I think, for both private stablecoins properly regulated and for CBDC.
It's very reassuring to hear that there's going to be place for both sovereign CBDCs and yet private stablecoins. I'm looking at the clock. We might go 2 minutes probably over. I want to spend some time talking a little bit around, as I said, going beyond cryptocurrencies and stablecoins and blockchain technology, right, and the potential for that. And I think we all agree, both in the private sector, in the public sector, the opportunities to utilize the blockchain technology. And I'm going to ask Sheila to lead off on that. It's fascinating to see that there's so many examples of opportunities where we can take current infrastructure, whether it's payments, lending, investing, insurance, and maybe in some cases incremental improvement by using blockchain technology, some cases dramatic improvement, cross-border remittances, right? We've grappled with 10% fees in cross-border remittances for 25 years. We've not solved that issue, right? And just going through SWIFT hasn't solved that issue either. That's an area where maybe blockchain technology could make a dramatic difference in dropping down cost, convenience, lesser risk, in improving payments. So talk a little bit about the potential of using blockchain technology in traditional payments or whatever financial function activity there might be.
Yeah. Well, I think there's a lot of promise. I think one thing, it's just reflected in earlier comments, some of the earlier approaches, Ben, we've got this shiny new toy called blockchain technology. Gee, what do we do with it? So there's been a lot of aspirational, and I've been guilty of this as well. I wrote an article in 2015. It was nirvana in terms of distributed ledgers, and it hasn't materialized yet, but I'm hoping it will. But let's identify what's wrong with the financial system first, and then can we use this technology to correct it? And again, I think there are a lot of areas where that can and should happen. Some will be incremental. I mean, there's a lot of fintech out there already. Doesn't rely on distributed ledgers, but online lending platforms. For domestic payments, fintechs have already created some real improvements in efficiency. So it doesn't have to be distributed ledger. It can be some combination of things. So it will be incremental building on the current the incumbent system in partnership with banks. A lot of it. Some of it will be completely disruptive. And it's the latter, I think, which is going to be the biggest challenge for regulators, because regulators, and I used to be one, you're very used to regulating a centralized system. Those large financial institutions, for better or worse, you know who they are, you know how they operate, you know who you can call, and going through a distributed system is going to be a complete sea change. And so, but we can't allow that to disrupt financial regulation either. Financial regulation will have to adapt. It'll be a different focus, probably less focus on credit risk, more on operational integrity, governance, and it'll require that people get paid more money so that you can recruit I know that's been an issue for everybody, the tech talent you need. But it needs to happen. It's scary, and you need to be careful and make sure we're replacing the old system with something better. But it needs to be embraced, and if it can improve the system, it should happen.
That sounds great. Well, I'm looking at the clock, and we could go for another half hour more. Let me just take a couple of minutes, and starting off with Ravi Shankar, just give our audience what is the one takeaway you want to have them walk away from this conversation about how regulators think about policy in this space. One takeaway that they should go back to the offices and say, this is what I learned from this session.
I think what I would want to be the takeaway from what I've talked so far is that regulators, just like the innovators themselves, private sector users, are looking very closely at the technology and the possibilities of that technology. Regulators are prepared that things are going to change and they have to change with it. But regulators at the same time, just want to add a bit of caution, which is that, let's think, define our concepts, define our objectives clearly before we jump into something new. I think a word of caution, but apart from that, they're probably as excited as anyone else about the way technology is evolving.
It's great to hear that regulators are excited about technology. I love that. Great takeaway. Adrienne, one thing that the audience should walk away with.
Rule number 1, never surprise your regulator.
You're here. You're here.
Well said. Well said. Sheila, one takeaway.
Well, okay, this will sound like a platitude, but it's sincere. I'm amazed at the work MAS has been doing. I had not focused on it before, but they are, and I love the way they're thinking about this, requiring that that proof of value be provided in terms of regulatory approvals, very clear criteria, the kind of things they're looking for. I love their sandbox approach. So it's been and what they're doing at CBC. So it's really been impressive, and I've learned a lot just about what MAS is doing, and that's probably my biggest takeaway personally. Yeah.
That's great. Well, folks, thank you for your attention and time. On behalf of the Singapore FinTech Festival and myself, pleasure and honor to have Superintendent Adrienne Harris from the New York Department of Financial Services, Mr. Ravi Sankar Tavarna from the Deputy Governor of the Reserve Bank of India, and from Sheila Bair, former FDIC Chair, policy regulator extraordinaire. So thank you very much, guys. Enjoy your show.
Thank you.